So what we're going to cover in this video in the first portion is three things: the best trade setup, the best day of the week, because I had the best trade setup. And what was it? It was a high probability trade setup on the daily chart, and specifically Emini S&P 500 micro futures. So daily chart setups that are high probability don't come around frequently. So the whole point is identifying it, showing up, being there, and executing on it. So we're going to go through that, and then we're going to cover all the charts. And I've added Bitcoin as a replacement for gold and the Dow Jones on my review videos. Let's get to this high probability setup first. Daily chart right here. And what you notice is this FOMC Wednesday candle. This is a large range down, and we punctured the first punch below the lower Bollinger Band. Second day, Thursday, on the 19th, we closed below it. Notice we tagged this blue line, which is the 3 EMA, but we couldn't hold it, and we closed below. So 2-day punch below the lower. And the third day, very scary in the hours before New York opens, because you see this discount candle wick. So this is the point where it can be very scary. We had 3 days of lower Bollinger Band exploration, price action, explored it, and bottom line, the third day, it especially went low. And this third day was 5865.75 on the low. And then by the time we got into after New York opened in the next 2 hours, we recovered everything above this lower, and we go and we reclaim back the 3 EMA, which closed at 5993.77. So there you have it. That's the setup. Whenever you have a 3 punch into the lower Bollinger Band on a high time frame, this is a very good setup. Is it 100% every time? No, nothing is. But I would say in my own back testing experience on the S&Ps on daily in the last several years, it's been above 75, 80% probability that we're going to get a chance to get some handles above this lower Bollinger Band on the third day. And that's what we did. This was this trade setup. The idea was buy early, and then at the end of the day, sell. And then you could see the end of the day on the wick. Price did not reach this middle Bollinger Band on the daily. So again, we're still technically in a discount. And because of we're before a holiday, notice the price candle reached the top, very close to the top of the candle wick of the prior day. So this was a close in the zip code of the 3 EMA. So that's how we closed. 3 charts. On the left, we have Bitcoin. These are weekly charts. So Bitcoin on the left. In the middle, we have the weakest chart, and that's the S&P 500. On the right, the Nasdaq 100. So why is the S&P the weakest? Number one, it did definitely close below this red line, which is the 9 EMA. And none of the other charts did that. Every chart on the bookends on the left, Bitcoin closed above it. Nasdaq 100, same thing. But you see the S&P 500 closed below 6025.36 is the 9 EMA. And the 3 EMA is 6061.38. We closed below that also. So we're going to most likely open Monday, which again, holiday week, not full days of trading for sure. I'm not going to trade Monday, but I'm saying Monday will open most likely an air gap where price opens and where the 3 EMA is. But this is, again, a weekly chart, very high time frame. I don't trade on weeklies, but I want to see what's symmetrical, what's happening. And these 3 charts basically are doing the same things, except the one in the middle, which had 2 weeks, 2 black candles on the down, where you can see Bitcoin, not so much, and same with the Nasdaq. But it's interesting, a long time ago, Bitcoin used to be thought of, oh, it's the antidote for being a non-correlated asset to equities, risk on equities, but that's not true. You can see it moves in tandem with other risk on assets in the equity class, specifically the largest stock index, the US stock index is S&P 500 and the Nasdaq 100. Next chart. So part of Friday's rally was you need an inverse relationship with equities against the US dollar and the VIX, which is the volatility measurement in the stock market. You can see we did have pullbacks. This is again daily charts here, and you've got a US dollar pullback below this red line, which was a weekly buy side liquidity level. What I'm really looking at on the dollar is this dashed line, because that's the consequent encroachment of a weekly fair value gap that goes back weeks and weeks. The VIX on the right side, daily chart again, 23.79% one-day pullback on the daily. So again, going back to FOMC, the day before, Tuesday, we had a tell. There was a gap here. You see this little gap where my green circle cursor is. And then that was an 8% move. And then we huge FOMC move up, giant. And then Thursday still stayed green, but it pulled back. And then we had finally a black candle here on the pullback. And we closed below the high of day 11 after the election results. So we'll see. I have no predictions. I'm just going to watch these two on Monday and the holiday week. But these are very important indicators, again, because they're inversely related to the direction of the S&P equity index. Next chart. Okay, we're going to go to my magnificent eight. Apple, Nvidia, Tesla, Google, Microsoft, oil, Bitcoin, US dollar. Apple, bell of the ball. Look at this for December, all new high for the month. So completely recovered. So that's one of the biggest cap weighted equities in the index for the S&P 500. Nvidia, good. We had a good green, strong candle close, and note how that close was the highest close for the week. So that was good. Tesla, on the other hand, not so much. Third day in a row, we closed lower. Google, we recovered, but not so much. And then with the Microsoft, a very modest green, but below still the body of the close of the prior day, Thursday. So Microsoft's not really all that healthy looking. Oil still in this dead zone. I'm not liking oil too much with just this very contracted range. I don't trade it, but I like to know if there's any major changes. So nothing going on. Bitcoin, we're going to cover on an individual chart next, but I wanted to just show here no help on a risk on assets with a third black candle on Friday. And then the US dollar, we've already covered that. What happened? We did get a pullback, but still note this big green candle on Wednesday. That fair value gap has not been reclaimed or closed. So that does it for the Mag 8. This kind of gives me a good idea of the health of the internals on key metrics on certain companies and indicators that I like to see. Next chart. Daily chart of Bitcoin. So one of the things about Bitcoin is we had this all-time high here for December, 108.97 and change. And then that was what day? That was the day before the Fed, the FOMC, took away the punch bowl from the party. And then here we go, the big sell-off. And what this created over 3 days was a very large daily fair value gap, which on Thursday, this black candle, you can see the premium candle wick respected entirely this daily yellow fair value gap. It did not get to that red line on consequent encroachment. It only got to the very bottom of that rectangle on yellow, and it just retreated and we closed low. And here we are on basically the third day Friday, and we go all the way almost to the lower Bollinger Band. Not quite, but we got there. So in 3 days, we're down 13.68%. That is basically the high to the low of the last 3 days, from FOMC high to the low of Friday. And we didn't close at the low of Friday, but the point was that's a pretty broad-based percentage pullback or drawdown compared to the equity indices. 2 observations. Number 1, the Bollinger Bands, the red on the top, the green on the bottom, and the black in the middle, we are in a discount technically, because the discount candle wick here is below the middle Bollinger Band. So that's my interpretation of a discount array on Bollinger Bands. But I'm bothered by the narrowness of the Bollinger Bands. We've gone from the top to the bottom, basically. And prior days, Bollingers were much wider, and now they've constricted. So we've got range contraction here on volatility in Bitcoin, and that would be a little bit of a concern, because if we get too much range contraction, that could lead to a very big breakout in a direction either way. And I'm not a breakout trader, but I'm just saying, let's watch this, especially into January in the first week or two, and see what happens. The main thing, though, for bulls is they're going to have to close above on a daily close, above the middle, and then attack this daily fair value gap. And as far as bears go, we do have a weekly fair value gap that's not been reclaimed. This goes back several days. That's about 80,000 on the price action, and that's not even the middle of that weekly fair value gap. So again, at some point in 2025, I do expect to reclaim this, because it's a much higher time frame, and it is an imbalance area that's going to create basically a magnet. People want to buy the dip. I'm just saying we could see a dip go lower. So those are the levels above and the levels below. Next chart. My go-to chart on the S&P 500. This is the 15-minute on the right, and we've got the range chart on the Renko with Keltner channels, upper Keltner, middle, lower. And I just do that to note here, similar to Bollinger Bands, where did we close at a premium or a discount? And you can see we're above the red middle Keltner, and that is on the Renko, and we are kind of consolidating on under and on this rectangle in gray. And move to the right on the 15-minute. What this is on the time zone, this is the Friday PM open range. So for 30 minutes on the afternoon, I measure it and then carry it over into the next day. This is from my mentor ICT, definitely has helped me out. And notice how price on these 15-minute candle bars really respected this open range and going lower. Now above here, this big yellow rectangle is a daily fair value gap. I've covered that in the prior video. And the consequent encroachment is 6060, 6060. And the high of the day was 6050, 6050.75. So you can see here, we settled back here in this flag. Below here, you see the levels. This was, again, prior video. The Fed's major 8:30 a.m. Eastern PCE inflation report. It's their preferred report that they like to look at. At the 8:30 hour, we had a 1-minute fair value gap. And then for several candle bars, we stayed in there. Price candle wicks. This was the tell, basically. We had candle wicks go near it in the zip code, but they never even touch this red line of this 1 minute. So that's the signal that this is gonna go long. And then you can see here we had a runaway breakaway fair value gap in the RTH New York, and we keep going all the way up into noon, and then we reach that high of day. So that's basically how we closed. Bulls need to close above this 606 because it's the consequent encroachment of that fair value gap where all the technical damage was done from the FOMC. That would be a marker, a line in the sand, if you will. And bears need to go back and get this breakaway fair value gap on the 15-minute. So that's gonna be 59.50 and below. So those are my levels to watch during the holiday week of next week. I'm not gonna put money at risk. I'm gonna show up. I'm gonna be there for tape reading. There'll be some abbreviated trade days, but I'm gonna watch these levels and the range on the left side on where we are with the Keltners. So that's it. Less is more. We're done with all the major catalysts on economic reports, earnings reports. I don't really see any planned large events, except remember, institutions will square their books at the end of the year going into 2025. So there could be a little bit more volatility on the downside just because of people wanting to get out of position. So again, making sure T+1, that's trade, plus 1 day to settle. That is the actual month end. The 30th, not the 31st, would be a true month end for settlement purposes. And that's it. Thank you so much for watching. If you've stayed this long, I appreciate you. Whether you're a subscriber or new to the channel, thank you. I appreciate your support. Aloha, take care, and have a happy holiday. Bye.